Hi everyone, some very good portfolio questions I've had, and they're very relevant to everybody looking at their portfolios and how to make the most of them this year as well. So let's get right into it. The first question, well actually I put them all on one slide and they are these. Okay, so the first question is, given the current environment, should I have more than 15 stocks per portfolio? Now, I think 15 is the bare minimum you should have. Some would say you're being relatively undiversified if you've only got 15, assuming that they're not all technology companies, all basically highly correlated, because that's really the key. How correlated are they? Then I'd say between 15 to 40. The reason I wouldn't go beyond 40 is generally you're pretty well diversified. When you think about the biggest retail fund managers, half of their capital, even if they've got $1 billion or $2 billion under management, half of their capital will be deployed in 10 stocks. Then they might have a long tail of another 100 stocks, which is a bit wasteful because it means they've got less than 1% of their capital in some of the companies right at the end. Now, 15 to 40, it's the correlation between the companies that matters, but beware of this warning. In a falling market, everything's correlation increases. So yeah, 15 to 40. Plus, we looked at our data over the last few years, and we found that if we had narrowed down from our approved filtered list to just say a control group of 15 or several control groups of 15 versus a bigger list, actually the bigger list did just as well. So it didn't detract from performance anyway. Okay, so that answers that. Should I purchase a mixture of US and UK stocks? Previously, I've been tech heavy and I've done well. Well, of course, everybody's been tech heavy and done well. Get that tech bias out of your head. It might return this year, but our longing for those halcyon days of, oh, tech just gives me money every day, you need to get out of your head. Otherwise, you're going to be looking backwards at a portfolio which doesn't deliver. That's the first thing. The second thing is I have been largely investing in US stocks for the last 22 odd years. The one time it became UK heavy was straight after Brexit because I could sell US dollars, buy British pounds, and get UK stocks that much cheaper. This is a year when I will look at some UK stocks. Okay, and I just think I think there's a few, not many. I think there's a few which will help. Have a look at my Telegram channel to see which ones I'm looking at. The links are usually in the bio somewhere around here. 3, should I look to purchase in multiple sectors for diversification? Yes, if all other things being equal, yes, unless you're just buying it for the sake of diversification, it's a rubbish company. Or does that not really matter? It does matter. What we mean by diversification is lower correlation between stocks. Now, you could get that within the same sector potentially, but it's more likely to happen between different sectors. For example, getting into some energy, healthcare, financials. Exactly. But actually, it's the fundamentals that we teach that matters the most. Valuation, growth, income. Don't just look at value stocks or just growth stocks or just healthcare stocks or just energy. First, start bottom up. And then if you've got a few which are in financials, then start to look at, say, the next one has to be in a healthcare company which meets your criteria. It's a bit like gender diversification on a speaking panel. Should I focus on quality mega caps such as Disney, MasterCard, JP Morgan? Well, just because they're mega caps doesn't make them quality, by the way. Disney in mine and wife's SIP and the rest of the stocks in our ISA. Now, this division between SIPs and ISAs is a separate issue, and I'll deal with that in a second. The second thing is a lot of people are finding comfort in having companies like Disney, MasterCard, JP Morgan, which are on my short list of stocks for this year, largely not because they're on the approved filtered list, but largely because of special situations. It's just how much they've fallen and how much they could rise. JP Morgan is on the approved filtered quality company, but the other two were special situations where it's more to do with price action. Whichever ones you pick, especially novices, they're more comfortable with name recognition, and that's fine as long as you know the reasons you're buying it. If you're still buying it, as I say, for 12 months, or you've set certain parameters that you expect it to do this and not drop below this, stick to those goals for the year. And if it doesn't meet them, then exit. Don't just hold on to it saying, oh, it didn't work, I'll just hold on to it regardless. So there is a comfort there. Now, SIP and ISA, the key difference is, whilst they're both tax-free wrappers, is that in a SIP, you really can't take the money out until I think it's 55, something like that. Not something I'm going to worry about yet. In an ISA, if you had to, you can take the capital out. You can't put it back in, well, you can take it out, but whichever ISA wrapper you took it out of, you've lost any future capital gains tax and income tax, dividend tax benefits of that capital as long as it's outside of the wrapper. And once you put it back in, you'd have to put it into a fresh wrapper's allowance, so the next New Year's allowance. But at least you've got access to capital, okay? And that's the benefit with the ISA. But it's not the case that, oh, with my ISA I take more risk, or with my SIP, because it's a pension, I don't. I tend to treat them both the same, unless you've got some other strategy, which is your business. 5, special situations. I know you have mentioned high risk. Now, these are companies which don't quite meet all my fundamental criteria of value, growth, income, cash flow, but nevertheless have reasons to suggest they will do well. Would Disney be slightly lower risk in comparison to, say, LRCX? I can't remember what that ticker is. Or ServiceNow, both of which I used to hold. Would it be slightly lower risk? Look at the volatility on it. You'll better find that on the internet. That's probably going to be a critical factor in the fundamentals. But beyond that, no, I didn't. When I picked them as special situations, I focused more on factors around the price movements, and they had enough of the fundamentals, but I didn't do a head-to-head of it being lower risk. PayPal, are you topping up for the long-term hold? No, I'm not topping up at the moment, but I do a weekly market review where I look at a whole bunch of bellwether stocks, which in about 6 to 10 minutes gets you right up to speed with the markets. I go through all the charts and give my analysis. So that's on YouTube every week. Do look at it, and on my Telegram channel. What percentage of total quality stocks are reasonable in this environment as a percentage of overall portfolio? I'm treating my portfolio as everything sort of pretty much equally held. So, you know, if I'm buying 40, then everything divided by 40. But actually what's happening at the moment is I'm pound cost averaging, because we're still not sure about the market direction. So I'm putting 1% of my capital, let's say, into, for argument's sake, I buy Disney. And to keep the maths on that simple, let's say that 1% is £5,000. So I put £5,000 into Disney. Then depending on the direction, I might in February or a little bit sooner add an extra 5,000. And so on. So it's relatively small amounts, but I do have in mind that of the, say, 40 stocks that I might own, or 20 I might own, I'll divide my capital equally amongst them, so I'm not unbalanced in favor of any one particular stock. Okay, that's how I do it. You don't have to do it that way. Some people, if they really like a company, they put all 99% of their money in there. I don't think that's sensible. Okay, hopefully you found that helpful. What I'd say is, everybody, please have a look at campaignforamillion.com. Lots of free resources, my books, my videos, articles on there. It's my campaign to teach 1 million people how to be better investors. Do have a look at that, and hope you enjoyed this video. Do give me comments, like, follow, subscribe. Do hit the like and subscribe, because it really helps numbers. Thank you very much.